Look at the holdings of Elon Musk, Jeff Bezos, and Larry Ellison. Combined, these three individuals possess a net worth exceeding $800 billion. Yet, for the majority of their lives, they have legally paid almost zero in income tax. Welcome to a special edition of the Wealth Building Principles Deep Dive, brought to you by Learn and Invest with Gabriel Biajoc. Today is June 5th, 2025, and I'm your host, Mira Astros. For the average wage earner, taxation is immediate and mandatory, deducted directly from every paycheck before the funds ever reach a bank account. At the highest echelons of capital, the system operates entirely differently, relying on bespoke legal frameworks designed to defer and eliminate those obligations. Before we break down exactly how they do it, a quick reminder. The information discussed in this podcast is strictly for educational purposes only and does not constitute professional financial advice. Investing in securities involves risk, including the potential loss of principal. Listeners should conduct their own research and consult with a qualified financial advisor before making any investment decisions. Have any feedback? Please email us at gabriel.ajac@hotmail.com and use the title of this series in the subject line. True extreme wealth is rarely built through a standard salary. Instead, it is manufactured through the massive multiplication engines of private equity, and then insulated forever by specialized wealth preservation cycles. Over the past decade, private equity has grown to a $12 trillion industry. It operates as a pervasive financial engine embedded in everyday consumer life, quietly driving everything from the premium dating apps on your phone to the corporate supermarket chains in your neighborhood. The core operation of a private equity firm relies on finding ailing, undervalued companies that are failing to compete. Firms pool millions of dollars to acquire these struggling businesses at a steep discount, with the specific intent of aggressively overhauling and restructuring them. Professionals use a 2 and 20 model, a 2% management fee, plus 20% of final profits. To maximize this, lean teams of 4 acquire failing targets, like Food Mart, and rebuild their entire corporate structure. Executing a turnaround of this scale demands a severe human cost. These small teams work 18-hour days, 7 days a week, spending 18 months transitioning an outdated grocery chain into an upscale brand called Farm Fresh. Once the brand reaches peak market value, the firm exits. They sell the rehabilitated company, frequently yielding a 300% profit. This secures massive returns for pensioner clients, while the deal team walks away with multi-million-dollar bonuses. By deploying the capital of everyday retirees, these firms take on immense institutional risk to engineer completely new market value. The extreme personal wealth of private equity partners is the direct mathematical result of that process. Manufacturing billions of dollars creates a massive target for the tax collector. To avoid this, the ultra-wealthy employ a specific 3-step financial cycle designed to provide liquidity without ever triggering a taxable event. Phase 1 is buy. They acquire assets that consistently appreciate, like real estate portfolios and large blocks of corporate stock. Crucially, they deliberately never sell them, because liquidating the asset immediately triggers a capital gains tax. Phase 2 is borrow. Instead of selling, they borrow cash against untouched portfolios. Elon Musk pledged 92 million Tesla shares to secure $50 billion in loans. The tax code treats loans as non-income, leaving borrowed money completely tax-exempt. Phase 3, die, transfers this vast empire to the next generation. A chart shows the massive tax liability normally owed on decades of asset growth, but inheritors receive assets with a stepped-up basis, instantly erasing all capital gains tax legally owed. By combining extreme asset appreciation with zero tax borrowing and inheritance loopholes, billionaires create a self-sustaining financial dynasty that operates completely disconnected from traditional taxation. The mechanics of elite capital reveal a stark reality for the wider economy. True wealth building requires moving away from a reliance on heavily taxed wages and shifting focus toward acquiring and holding appreciating assets. If you had full access to the buy, borrow, die framework, how would it alter your own legacy planning? And does understanding the sheer scale of the system change your perspective on whether our financial regulations require reform? We also have to weigh the severe human cost of the multiplication engine. When you factor in the relentless 18-hour days required to reach the top of the private equity ladder, You have to ask yourself at what point the pursuit of capital begins to compromise your mental and spiritual health. Finally, does your personal pursuit of wealth align with building a purpose-driven life, or is the accumulation of capital becoming an end unto itself? The elite operate through two parallel systems, one that manufactures immense value through private equity restructuring, and another that shields it permanently through borrowing and inheritance codes. Navigating this economy means understanding that asset holder mindset.
Society trains us to reach for immediate, tangible rewards. We are taught to prioritize the perceived security of a stable salary, while remaining blind to the mechanics of ownership and long-term freedom lying right behind it. Compare that conditioning to families who have operated outside the standard paycheck cycle. These lineages have successfully multiplied their capital and influence across multiple centuries. Standard formulas for quick cash fail because they are simply chasing a larger salary today. Building genuine, lasting wealth requires abandoning that pursuit for a distinct psychological baseline and a rigid structural blueprint. The blueprint starts with recognizing that money is a passive tool. The ultimate active asset in wealth creation is a disciplined human mind. This requires emotional and verbal control. Staying calm when annoyed and avoiding gossip naturally elevates your value and earns others' respect, creating a stable environment where you can weigh important decisions without impulsive interference. This diagram highlights the divergence in time horizons. The middle class plans life around a repeating, bi-weekly loop. Dynastic families stretch their planning across decades and centuries. By extending that timeline, they give the mathematical power of compound interest room to breathe. Growth occurs uninterrupted by the emotional panic that drives most people to sell early. The actual barrier separating the middle class from dynastic wealth is rarely the initial starting capital. It is the mental fortitude to delay consumption for decades at a time. With that timeline established, the focus turns to acquiring appreciating assets. This means buying land, building businesses, and securing intellectual property rather than trading finite hours for income. Formal education functions as a system to learn structural tools like legal frameworks, negotiation, and financial literacy. These meta skills allow families to navigate the rules of wealth rather than just training for a job. Wealthy families utilize good debt to finance asset acquisition while deploying diversification across those assets to manage asymmetric risk. This balance allows for growth without vulnerability to a single failure. They also rely on meticulously curated ecosystems of power. These historical networks grant access to exclusive capital and strategic information, ensuring the family remains within a self-sustaining circle of influence. By prioritizing those assets and metaskills over standard degrees and salaries, the creation of capital becomes decoupled from any single individual's physical labor. Once capital is acquired, it must be defended. The elite utilize a specific legal architecture to protect their portfolios from taxes, external threats, and internal mistakes, trusts, and family offices. This flowchart demonstrates a strict legal boundary. The structure insulates the family wealth vault, walling it off from external business risks. A market shock might hit a company, but the core legacy remains untouched. Within that vault, trusts act as programmable software for the capital. They define the exact conditions for transferring funds to descendants, bypassing the public probate system. These legal mechanisms essentially code survival into the money. They ensure the preservation of capital, even if future generations make poor personal or financial decisions. The core of this architecture is a concept known as the custodial mandate. Legacy builders view themselves as temporary caretakers, tasked with protecting the family wealth, rather than owners entitled to consume it. Capital allocation becomes an act of emotional asceticism. It is the deliberate, selfless act of planting a tree, fully knowing you will never live to sit in its shade. Escaping the trap of the immediate reward requires an evolution in 3 stages. You must shed the mindset of a consumer, adopt the discipline of an owner, and finally, embrace the duty of a steward. When you pair this sense of duty with the emotional control required to stay calm and focused, you earn a level of respect that outlasts your lifetime. You stop consuming for today to architect a permanent legacy for tomorrow. As always, learn and invest.